Welcome to our September update. Unofficially, we're about 6 months into this pandemic and have certainly seen a roller coaster in the financial markets. The tech-heavy NASDAQ as well as the S&P 500, for example, certainly puffed up the markets, and from outward appearances, the markets have rebounded since the beginning of this year. In many cases, they've even surpassed it. However, as mentioned in recent updates, many sectors, especially those ones that we see in retirement portfolios that have higher dividends, etc., have yet to rebound. Notice here in our illustration, on the left there we see the size of the companies, large, mid, and small. And from left to right, we see the different sectors of value, core, and growth. Now, one example of growth would be that of tech stocks, technology. Good example of value stocks or high dividend stocks such as AT&T. Now, in the past few days, there's been a recent pullback in tech stocks, make up the large cap value space. A sharp decline of 10% or more in just a matter of days. And this is easily understandable, maybe some profit taking as the markets of that sector has been up over 22% in the past year. It makes sense to maybe take some profits off the table, use it in other investments. Of course, there's been some disappointments as well in individual stocks such as Tesla, which carries much weight in the markets as it's lost over a quarter of its value in just a short period of time. But really ignoring all of that, many still wonder, what is the next 10% move in this space? Is it going to be up or is it down after having such a good year already? Many worry about that. Now, on the upper left, traditionally safer large cap value stocks, they're still down over 10% in the 1 year number. Now, many of these stocks are still great companies, not in any financial trouble really, and have nice dividends, but have fallen out of favor because of their high-flying counterparts in large cap growth. We see that the spread there between -10 and +22%. We can see why. Now, from a markets perspective, the anxiety in the markets, the COVID cases seem to be manageable, and the financial markets are factoring in that there's a balancing of life, economies, safeties, etc. And of course, they can't ignore the much anticipated vaccine that may be available in the coming months. So with all of this enthusiasm and optimism, we see some safety returning to the markets. So with that being said, we're going to be looking soon to use some of the cash positions that we've accumulated in the past few months to take advantage of some of these distressed sectors, the mid and large cap value. They're still very undervalued year to date. But you might ask, well, why not bonds? Why don't we just pack on the bonds until this pandemic is over? Well, notice here in our next illustration of our current interest rate yield environment. As you see, this is the yield of the 10-year Treasury notes. Somewhat stabilized since the beginning of the pandemic after a sharp increase, earlier this year. But really, this is still about 1.5% less than the yields this time last year. So yields are very low on bonds. What this means for you is that the current value of the bonds in your portfolio have become more valuable. Higher interest rate bonds, now that interest rates have come down, the value of your bonds have went up. So the real return on the bonds in your portfolio has increased very nicely this year. However, it also means that purchasing new bonds, adding new bonds to your portfolio, means that we're buying bonds with pretty dismal yields as well, not even 1% here on the 10-year Treasury. Or it also means that if we buy existing bonds that may have higher yields, it means that we're going to be buying them at a pretty handsome premium. So is there any silver lining to having such a low interest rate environment today? Well, notice here in our next illustration how it may directly affect in the future. This is a graph of how the low interest rates have affected mortgages. Mortgages on new homes have increased, and refinancing on existing homes has increased as well. Well, the silver lining in this particular case is we see that credit is still flowing very nicely. We're not facing a credit crisis, what we did about 10 years or so ago. But it also means that we're going to see some direct savings in mortgage interest, a net positive in cash flow, then, so to speak. And in future, that this net positive cash flow will buoy stocks in the future, purchasing in the future. So to answer the question, that being said, we're not looking to pile up on adding new bonds in the portfolio, just waiting the pandemic. No, we weighing out the risk versus return to maintaining cash positions, the safety and security of holding cash and money market positions, as well as valuing these distressed stocks, as we just mentioned before. So we're happy to sit on cash and wait for some future bargains in stock. So we appreciate your time once again and patience, as these have been very difficult times, not only personally, but also financially for many of you. So we thank you for your continued business with Baumgren Retire Plan. But of course, we certainly enjoy speaking with you one-on-one. Please email me back, or you can use the book a meeting feature in my email so we can speak one-on-one. I'm always interested in your perspectives and obviously any changes in your financial situation. And of course, we'd like to be able to see you all again very soon.